You say more austerity is the wrong move, and of course austerity is what the two sides would have to agree to in order for Greece to get more money. Yet the negotiations now are all about politics, aren't they?
Well, I don't necessarily think austerity is the wrong move, but I think it'd be a very difficult move. Remember, you're talking about an economy that's very much suffering from dilapidated growth, struggling amid a debt-to-GDP ratio near 200%. So when we talk about implementing a realistic austerity program, there really isn't one that you can expect without sending that economy into deep, deep recession for years, arguably decades. So I think the end game is really the same as it has been since negotiations started several years ago, and that is to allow Greece to go back to their domestic currency and inflate some of these price pressures away, some of this debt away. Now, of course, the end game for the Greek people would then be the same, a decline in the standard of living. But from a political standpoint, I think we can all agree it's much easier to sell inflation than it is austerity.
Sure, certainly. A big question, though, for investors, for anyone who's watching the market, is whether a Greece default would look like Lehman Brothers, where the fallout is unimaginable and unspirals very quickly, or something like Radio Shack, where the collective reaction is kind of, it was kind of expected. What does it appear now, based on the years, the months, the weeks of negotiations, that the market has seen as that the market now factors in as the default scenario?
Well, certainly this is unprecedented territory. So if we did see a Greek default and eventually Greece exiting the euro area, we certainly do expect an extreme amount of volatility, as this would be an emergency type situation for the government in Greece. But we have to keep this in perspective that Greece is just 2% of the eurozone. So we're not talking about a vast percentage of growth in the area. And so I think cooler heads would prevail in the near term, and it would not be seen as a domino type scenario, meaning that investors would not be looking for who's next. Is it Italy, Spain, Portugal? These are economies that are quite different from what we're seeing over in Greece.
Certainly. I want to bring this over to the United States because there's an argument that some people have made, which is the whole Greek drama is good for U.S. markets because it keeps the rally in check. Prices and bullishness don't get out of hand because the uncertainty creates an overhang. We've heard Janet Yellen, the Fed chair, refer to prices being a little bit rich, the valuations being a little bit extreme. Maybe this keeps this from getting even worse.
Well, certainly I think if we do see the type of scenario where Greece leaves the eurozone, we would see, again, that increased volatility, forcing investors to look for that flight to quality trade. So I think this would continue to put downward pressure on rates here in the U.S. Also, from a currency standpoint, on a relative basis, certainly the dollar has benefited over the past several months, and this, too, would create an upward momentum scenario for the U.S. currency as well.
I want to turn to today's economic data, which is the University of Michigan Consumer Confidence Report. It was higher than expected, and in fact, it capped the most optimistic first half of any year since 2004. Why is uncertainty, whether it's over Greece, whether it's over what the Fed does next, not putting a dent into consumer sentiment?
Well, remember, last month we fell to a 6-month low. So now we've reverted back to what is a 5-month high in that final June print. So consumers are very concerned. There is a lot of volatility in the marketplace. But I think the idea that the economy has improved from that general malaise that we saw January through March, that's beginning to make consumers feel more confident about their current situation. But remember, optimism can only last so long. We need to see that actually follow through, come to fruition in the underlying data, and that means that long-term confidence will be supported only by organic job and income growth. So we need to see further momentum in the second half of the year.
And speaking of data, we know the Fed is data dependent, and we've got a big data point next week. On Friday, the jobs report due out, and of course this comes before the July 29th FOMC. We'll get another one then. What are you looking for in terms of what that report would mean to the calculus of what the Fed does next?
Well, it's interesting because it seems as if the bar of expectations for labor market improvement has continued to be lowered throughout the year. Remember, the market seems to be looking at any size of report above 200,000 as good enough. But remember that good enough at 200 to 250,000 is a significant step in the wrong direction from that plus 325,000 pace that we saw at the end of last year. So we are expecting for employment gains to remain positive, but very modest and certainly well below what we saw at the end of last year.
Okay, so there's still some moderation compared to the end of last year. We also have ISM numbers due out, and manufacturing has been a bit of a weak point for the U.S. economy. We've seen sentiment and spending pick up and holding up better, certainly, than earlier this year, but manufacturing has been slow to recover. Does that change?
Well, manufacturing certainly was the silver lining to that 2014 rebound that we saw in the middle part of last year. But after producers realized that above-trend 4.5% GDP pace was not being maintained as we saw the economy slow in the final quarter of last year and further into this quarter, we did see a pullback in production, in employment, in new orders, and we do expect for that. It's still positive, but loss of momentum, underlying trend to continue into the second half of the year. So again, still positive production, but it's that second derivative decline or that loss of momentum that's really concerning when we compare it to production levels that we saw this time last year.
Yeah, the rate of change and the trend overall. All right.